And hedge funds in the U.S. at the moment, all trying to outperform the market. Some high-profile collapses during the credit crunch of the past months have shown not all of them are likely to survive. A study from the research firm Prince & Associates suggests that even absent a crisis, the industry is overpopulated and ripe for consolidation. Charles Gradante is co-founder of Hennessee Group. He's appeared before the House, Senate, and SEC to talk about hedge funds. He joins me now with his views on what the hedge fund outlook is. We have too many hedge funds?
Well, you could say that. 9,000 seems like a bit much, but we have 9,000 mutual funds. And like mutual funds, there will be some hedge funds that will fall by the wayside due to performance or inability to grasp enough assets to support buying talent and the overhead. But I think the real consolidation story is more about the bigger hedge funds having a lot of their equity, not only capital, but only their personal equity in building the firm up. Like Highbridge, who was bought out by J.P. Morgan. And the only way to monetize that equity buildup is to allow themselves to be consolidated with a bank. So there have been several consolidations by hedge funds into the banking system. For example, Lehman Brothers has minority interest in D.E. Shaw, Liberty View, Osprey, and GLG. Morgan Stanley has interest in Front Point and Traxys, who is managed by Barton Biggs. And Citigroup has purchased 100% outright ownership of Old Lane hedge fund. And Morgan has Highbridge. So the impetus for consolidation is mainly to monetize the hedge fund managers' equity interest in the hedge fund. The question becomes, why are banks doing this? And the answer is very simple. They're into the fee business game, and hedge funds generate a lot of fee income. There isn't a whole lot of capital that a bank needs to put up other than margin to support a hedge fund.
What about the idea of a lot more going public? We saw Dan Ox taking Oxif public today.
Public, and Carl Icahn is thinking about going public. That is another way of monetizing your ownership of a hedge fund.
Can a lot of people do that, though? Is there enough attraction to the general public to own shares in some of these?
The big guys can do it. There is attraction, and we'll see how much attraction there is, but it is a way of investing in proprietary trading activities through the stock market without having to put up $1 million, $5 million. Oxif's got a $10 million minimum. So if his stock is trading at $50 a share, that's a nice way of getting into a proprietary trading act.
But can the smaller guys compete with these big behemoths now? Some say, I guess it's better to be smaller and more nimble.
It used to be better to be smaller and nimble, and it still is better. However, the problem is that most of the capital flow coming into the hedge fund industry these days is coming from big institutions who are putting $100 million at a clip in a hedge fund. Therefore, a hedge fund that has $500 million or even $1 billion under management won't satisfy the institution's need to only be less than 5% of the hedge fund. Figure it. If you're $1 billion in size and a university comes with $100 million, there'll be 10% of your fund. So right away you're disqualified So the big money, pension plan money, endowments, foundations are going to the bigger hedge funds, $6 billion, $7 billion, and so the bigger funds are getting bigger, and the smaller funds are on the sideline right now.
Charles Grant, thank you for joining us today.
You're welcome.